Now, let's say gold keeps going up and we see $5,000 an ounce gold, which we totally can in the next few years with the forces at play right now. And then the gold to silver ratio goes to something like 50 because silver is going up faster than gold is. Then you get a really high price for silver, so triple digits is conceivable at that point. So yes, if you buy silver at $40 an ounce right now, it feels like a lot, but if it's going to go to $120 an ounce, you still triple your money and protect yourself along the way from all the chaos. So I think this is still a reasonable time to buy silver.
In a typical precious metals bull cycle, gold moves first. It's the gateway asset, the one most people reach for when inflation creeps in or the system starts feeling unstable. It's familiar, it's historic, and when fear rises, gold gets the early bids. But here's the thing, silver is where the real upside lives. JohnRubino of dollarcollapse.com makes it clear, if you're holding silver before the mania phase kicks in, you're already ahead. Even buying at $40 could look like a steal if silver runs to $120 or beyond. That's not just a 3-buy trade. It's a direct hedge against financial instability that's becoming harder to ignore. Unlike gold, silver has a dual engine. It's money and a key industrial metal. Demand is surging from solar energy, electronics, and the broader green tech push. Photovoltaic solar cells, the backbone of solar panels, rely on silver to conduct electricity. As global infrastructure pivots toward renewables, silver's utility is becoming as crucial as its monetary role. Rubino notes that precious metals often take a breather in late spring and summer, particularly after Asia's heavy wedding season buying fades. So don't be surprised by short-term weakness. But the big picture, gold remains in a solid uptrend. Unless we see a real breakdown, something like a 20% drop from here, the bull market is still very much intact. On the macro front, the setup is increasingly favorable. Silver is trading around $37.20 as of Thursday's Asian session, boosted by a weakening dollar. And politics may be about to add fuel to the fire. If Trump returns to the White House and leans on the Fed for looser policy, which he's done before, lower interest rates are likely. That means negative real yields and further erosion of the dollar. Both are rocket fuel for gold and silver. The rotation has already started. Gold is serving as a leading indicator. But silver? It's coiling. And when it breaks out, it moves fast. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, the way precious metals bull markets normally work is gold goes first, because that's the thing you get into when you really don't understand the whole concept of inflation hedges and real money and stuff like that. But you've heard of gold and it goes up in those kinds of situations. So you buy that first. Excuse me. And so gold's price goes up. And eventually it gets to a point where you compare gold to silver, for instance, via the gold to silver ratio, which tracks the number of silver ounces it takes to buy an ounce of gold. And when that number gets huge, in other words, when it takes a lot of silver to buy an ounce of gold, and so for the price of a crew grand, you can get 70, 80, 90 ounces of silver. People start switching to silver at that time. And silver is this little tiny, thinly traded market. So it begins rising dramatically in percentage terms, and it outpaces gold for the rest of the precious metals bull market. So you get gold taking off first, then silver catching up to it, and then exceeding it in percentage increases. And the last year or two of a silver bull market is usually just straight up. It's just this crazy parabolic move when there's no silver left, and whoever's going to buy it has to pay whatever price the market is offering it at right now, and that means you're basically buying at the market in a very thinly traded market, so you're paying way up. So you basically want to own your silver before that happens. And 2 years ago would have been the best time to do it, but this is still a reasonably good time in terms of where silver might end up. Let's say gold keeps going up and we see $5,000 an ounce gold, which we totally can in the next few years with the forces at play right now. And then the gold to silver ratio goes to something like 50 because silver is going up faster than gold is. Then you get a really high price for silver. So triple digits is conceivable at that point. So yes, if you buy silver at $40 an ounce right now, it feels like a lot, but if it's going to go to $120 an ounce, you still triple your money and protect yourself along the way from all the chaos. So I think this is still a reasonable time to buy silver. And absolutely, the silver miners, there just aren't very many of them. And once people start thinking in those terms, thinking, wow, my silver's way up, let me buy a miner because it'll go up even more than silver. And you just won't find that many silver miners available. And their prices will also go parabolic. So there's definitely a play out there. There are mining stocks right now that are reasonably priced given what might happen. Given, a parabolic move in one of the metals, then the miners will just go crazy. So their current price compared to that speculative future price is super cheap. So I think that you don't necessarily want to buy the miners at the market right now, but get in using low ball bids. Say come in at 10% below today's price, and then hope that bid gets hit in the next correction. Things like that, or sell put options as a way of getting into a mining stock cheaply. And always, if you find one you like, don't buy a lot up front. Buy some and then dollar cost average your way into the rest. So you want to try and get the best average price possible, and not be too overexcitable, because that's when you get burned. But just know that this is a trend that's in place, and just ride it by buying a little bit at a time and hoping that your average price ends up being really favorable at some point in the future. Gold has kind of blown through its seasonally weak period a couple times, so people are paying less attention to it. But historically, it usually you do want to sell or at least stop buying in late spring, early summer. And there are good reasons for that, especially in Asia. The buying tends to pick up in anticipation of spring weddings when a lot of gold jewelry is given and silver jewelry. And so the buying kind of peters out after that, after the spring buying is done. And so you get kind of summer doldrums, and you frequently get lower prices for gold and silver. I know I've been burned by that a few times, where I thought, big spring, maybe seasonality doesn't matter anymore. Let me keep buying. And then by July, I wish I had just paid attention to seasonality. So there's that too for precious metals. And the chart that you've got up is a very healthy chart. That's a bull market chart right there. And from a technical standpoint, that won't change until when and if gold pierces the lower band of its upwardly sloping trading range. So let it drop, I want to say 15 or 20% from where it is right now. And then you would get a technical signal that maybe the bull market is broken and other things are going to happen. But there's nothing like that on this chart so far. And there are good fundamental reasons for precious metals to still be rising. And this might be a good time to segue over into the whole Fed debate that's going on right now, where Trump, who is an easy money guy, wants lower interest rates. He's been buying real estate for 50 years, and cheap money is the way you do that. So for him, lower interest rates are just a no-brainer, especially if you have the power to make them happen. You obviously make them happen. So he's bullying the Fed right now in various ways and demanding that they lower interest rates, and he'll eventually get his way. Either the Fed will capitulate and start cutting, or the Fed governors will leave and Trump will put his people in who will just immediately lower interest rates back to zero or someplace like that. So that's a very positive thing for precious metals. If you've got lower interest rates in the not too distant future, then that's the kind of environment that you like to see when you're an inflation hedge. If somebody's buying gold and silver because they're afraid that the dollar is going to be inflated away, well, let us move interest rates down to zero again while running massive deficits. And you've got the environment where the dollar is being inflated away, and you want to be in things that will protect you from that. So that's probably a 50-50 bet right now for our future of the next couple of years, where we're back to aggressively devaluing the dollar, and the things that benefit, the real things, are doing very well. Between the trade wars on the one hand and a lot of indicators of an upcoming recession on the other hand, and equities are set up for a crash based on history. Every time we've been at these valuation levels, the next couple of years have been brutal. And then geopolitics is still really unsettled. And these multiple scandals are potentially big deals for the financial markets, just because when politics is unsettled, so is finance usually. But the whole Epstein thing, followed by the Trump-Russia collusion thing, these are all really big deals. But as a gold bug, I'm still paying attention to gold and silver more than anything else. And right now, gold is consolidating, which means it's just trading back and forth in a really narrow pattern as it figures out what to do. And that's not a surprise at all, because it had a phenomenal 2-year run. It's up $1,000 an ounce in just the past 12 months, which means there are a lot of people with profits to take in precious metals right now, especially gold. So they're selling, but new people are coming in and buying, and you get these up and down days that don't really amount to much. And that's basically a healthy thing in a bull market. You've got to have consolidation periods while the weak hands hand off their assets to the strong hands, who aren't going to sell at this price for any reason. And then you can resume the upward momentum again. So that's probably what's going to happen with gold. But meanwhile, silver and platinum are outperforming gold, which is a really good sign, because that means the commodities bull market is broadening out. You don't just have one or two things leading the way and everything else lagging. So basically, this is a healthy environment for commodities in general, and precious metals in particular. So I'm basically, despite all the crazy stuff going on, I'm pretty happy with the central thing that I pay attention to. But all of this other stuff could change that on a dime. There are all kinds of things that could happen that would go from being ominous to terrifying in a heartbeat. So we can go through that list if you feel like it.
The Fed might be talking rate cuts, but the bond market isn't buying it. It's flashing warning signs. Yields on long-term treasuries are rising, precisely the opposite of what you'd expect if the market believed rate cuts would fix the system. Here's what's happening. When investors buy bonds, they're lending money and expecting to get paid back with interest over time. However, if they start to think that inflation is returning, or that governments are losing control of their fiscal policy, they demand higher yields to compensate for that risk. That's what we're seeing now. According to JohnRubino, the heart of the problem is simple. Governments, especially the US, need lower rates. Cheap money keeps the system from buckling. It props up consumer spending, keeps debt service costs manageable. However, the bond market no longer trusts the trajectory. Long-term yields are climbing, not falling. And that creates a massive contradiction. Let's get back to the interview.
The bond market is worried about what falling interest rates would do to the inflation rate and to bond valuations, and they're demanding a higher rate of return when they invest in bonds. When you invest in a bond, you basically lend money to somebody who promises to pay it back to you in a future date, while paying a little bit of interest at a time on a monthly basis or whatever. And if you're worried about the future, you're less likely to lend in that way by buying bonds, and you want a higher interest rate to make it worth your while. So that's what the bond market is saying. They're saying, well, okay, if you're going to be reckless with monetary policy, then we're not going to go along with this. We're not going to accept lower and lower interest rates just because you tell us to. You got to behave in a way that makes us comfortable with the inflation rate of, say, 2 years to 5 years hence. And the bond market is not comfortable right now, and that's just not just in the US. Lots of other countries' bond markets, notably Japan's, are having the same kind of behavior where, the government may want lower interest rates and start lowering interest rates in the short end of the spectrum, but the bond markets don't cooperate and long-term rates go up. Now, this becomes a big problem if interest rates go up too much, because long-term rates will choke off economic growth if they rise beyond a certain point. Mortgages, for instance, key off of the 10-year treasury yield. So let the 10-year treasury yield rise from here, and that means mortgages go up. It also means car loan rates go up. So you can choke off economic growth if long-term rates go up too much. And you can also bankrupt governments who have to pay interest on their debt and who are accumulating a lot of debt. The US has $1.5 trillion in interest expense already per year, and we have to borrow that, which raises the deficit in the future, and debt piles up even more, and our interest, we have that kind of a death spiral thing going on if we can't lower interest rates across the yield curve. So this is a big dilemma and a potentially big crisis if it doesn't work. If easing doesn't work, in other words, if it makes long-term interest rates go up, then we're out of tools. There's no way to fix an over-indebted financial system if you can't inflate away the debt. And that's a very real possibility in our future. If we cannot liquefy the system in a way that makes long-term interest rates lower, dramatically lower, then we're done, as a financial system. And I think that day is out there waiting to happen. There's always going to be a time, there will eventually be a time when the tools for inflating away debt no longer work, and the whole fiat currency experiment just breaks. And it feels to me like we're close to that, because government interest costs are going up dramatically while long-term rates are not falling. So that's the beginning of that kind of a process. So watch it. And if it doesn't change over the next, say, 6 months to a year, then that's a sign that the experiment is ending, and something else has to be put in its place. And the governments of the world either have to choose to do it right away preemptively, or have to wait for a gigantic crisis to come when they're forced to do it. So either way, you get a monetary reset out there. And it's just how big is the crisis before it happens? Bond buyers and bond owners are not impressed with the US yield right now, or the Japanese yield, or a lot of European yields. And they're just not interested in buying that paper. And in the case of countries and other entities that own a lot of treasury bonds, they're not really that excited about holding the bonds that they have. So yeah, you get a bond crisis when something like that happens and spins out of control. So we won't default in the sense that we're not going to stop paying interest on our debts because we have a printing press. We can create all the currency we need to pay the interest, but we can't control the cost of taking on new debt. In other words, if interest rates go up, that means we have to pay more in order to borrow money. And that's the part that breaks the financial system. If the cost of borrowing and maintaining your debt starts to rise in an uncontrollable way, in a disorderly way, then you're basically out of tools, And when people figure out that you have no fix for this, then you get the crack up boom. The Austrian School of Economics event where people just give up on a currency because they recognize that the government has no choice but to inflate that currency away. So they just dump it by buying real stuff whenever they get money. And then that means you have hyperinflation in real assets because everybody's trying to dump their currency by buying real stuff. And the system just breaks. This has happened many times in human history. But what's different this time is that it's happening globally. Usually it was one country in an otherwise sound money world screwing up its currency and having something like a crack up boom happen. But now we're looking at it globally, where most of the big countries are in some version of this fix and are heading for basically the same place where their currencies start falling rapidly towards their intrinsic value of zero. And so we've never seen this happen on a global scale before. So from the standpoint of a finance nerd, this is fascinating. We've never seen this kind of history take place. They'll be writing about this, assuming there are historians still writing about history 50 years from now. They'll be writing about this period. And so we get to live through it, which is horrifying for 99% of the population, and interesting and potentially very profitable for the gold bugs and the libertarian economics people out there, because they tend to understand what's happening and are able to prepare for it. So, that's kind of your job and my job, is to convince a growing number of people that this is what's coming, and talk about how you prepare yourself for it. These charts are a good example of how inflation distorts financial reality. Because it makes it look like things are going up when, in terms of real money like gold, they actually aren't going up at all. They're not being more valuable. And yeah, we could easily be in the early stages of a crack up boom, because you're seeing real things like gold and silver, and still houses, amazingly, although that might be ending, because that's a wildly overvalued market. But a lot of commodities are going up right now because they're real things that you can't inflate away. And the stock market right now is a very narrow market. It's being led by just a relative handful of companies that seem bulletproof. So capital is flowing into things that look like they're going to continue to succeed in an accelerating way, like Nvidia or something like that. But the vast bulk of the stock market right now isn't rocking like that. They're not looking like the Nasdaq, the S&P 500, although it's doing okay too. But it's being pulled along by this handful of really powerful tech stocks mainly.
You can't stimulate an overleveraged economy if the cost of long-term borrowing keeps going up. Rising 10-year yields translate to higher mortgage rates, more expensive car loans, tighter credit conditions, and ultimately, slower growth. That's not a path to recovery. It's a feedback loop of pressure on both households and governments. Rubino's point is this: the Fed can talk about easing all it wants, but if the market doesn't follow, it doesn't matter. Without confidence in the system, no amount of stimulus can force capital to behave. Fear may spark the rally, but utility drives it further. Silver isn't just reacting to macro stress, it's feeding off a structural shift in how the world is powered and how wealth is stored. With its dual role in both industry and finance, it's quietly positioning itself as a strategic asset in a world where fiscal discipline is waning and currency values are losing credibility. Meanwhile, rising bond yields are calling the Fed's bluff, revealing a growing rift between market behavior and policy spin. As this pressure builds, silver's breakout potential looks less like speculation and more like a recalibration. If silver's trajectory is now tied to both monetary erosion and industrial demand, how long before the market stops treating it as a follower and starts pricing it as a leader? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.